All right, so this will be the 5th video in the capital markets series discussing splits. So let's take a look at splits. We'll start with the least divisive of the two, right? So we'll do the forward splits. Now, forward split is if you have a $5 price per share and you do a forward split on 1 to 5, now you're trading at $1, you've lowered the price per share. Why does a company do this? There can be many reasons. Primarily, it's going to be to entice or bring in new shareholders, new investors to buy in. It makes it more attainable. It's less expensive. I know at $5 a share it may not seem that way, but now you're talking about companies that might be trading in the hundreds of dollars per share. They want to lower it and let some people buy it. And it also increases market liquidity. And this could be leveraged. This is a very valuable tool. It can be very powerful for companies to do so. So there's that. Now, as far as reverse split, this is an interesting tool. An interesting subject as well, because I've gotten a lot of phone calls on this over the years and even had quite a few shareholders upset with me because I refused to do one. And then, of course, subsequently, everyone says I hate reverse splits. That's not accurate. And I've said many times previously, my issue with them is that they are a widely misused tool by companies that have less than honorable intentions. We'll put it that way. So let's go through an example of how a reverse split works, because there's a lot of misinformation out there, and then we'll talk about a few items that will reference this particular example. So let's say if a company has an authorized share count of 100 million shares. They've got 50 million outstanding. This will contain the float. So you have the outstanding shares as the issued and out shares. This can contain the shares that have been issued that still have a legend on them or a restriction. We discussed this in the previous video. And then, of course, the float, which is what's actively being traded every day. Let's say this company is trading at $5 a share. They have, again, 50 million shares in the outstanding. So they're 50% issued. At $5, they're $250 million company, or a simplified market cap of $250 million. Let's say their rolling 30-day is 1 million shares a day at $5, so they're trading $5 million worth of volume a day. So those are dollars traded daily. And this particular company decides to do, for whatever reason, they want to do a 10-to-1 reverse split. So now that brings that $5 price per share to $50, right? So a $50 price per share, but it also is going to reduce, not the authorized. The authorized remains ineffective. This is important to remember, okay? Authorized, separate. Outstanding share count is going to be reduced from 50 million to 5 million. That's a big reduction, right? So the average 30-day is going to be estimated at 100,000 shares a day, or again, the same as before, 5 million shares a day. That's not a great way to estimate what it's going to be post-reverse. There are many factors that go into market liquidity post-reverse. You could potentially see an increase because it's viewed negatively and there's a sell-off. So volume will increase. That's not necessarily a great thing, right? And then you'll see a drop-off on the amount of trading. These are all factors to consider when deciding whether or not to do a reverse split. So now that we have this company, let's take a look at a shareholder that has got 1,000 shares before the reverse split. So it's 1,000 shares, $5 a share. He's at 5,000 shares. I'm sorry, $5,000 worth of shares, or $5,000 of equity in the company. Post-reverse, or after the reverse split of 10-to-1, he still has $5,000 in stock, but he only has 100 shares. Is that good or bad? There's no net change to your account, so it's irrelevant. I know if I still had my 1,000 shares, it'd be worth even more now because it's at $50,000. I never understood why people look at it that way. That's not realistic. That's not going to happen. At some point, if that was to happen across the board with thousands of shareholders, you're exceeding the market cap of the company or even the authorized. So how does that work? It's odd to me when that keeps getting brought up as a reason it's bad. There's so many reasons that it could be bad. That's not one of them. That's kind of fantasy land in my mind. So the result of a reverse split is what? No net change to a shareholder's account. Nothing changes. You still have the same dollar amount. SEC wouldn't allow it if that did change that. So that's one way to look at that, okay? The other thing is there's going to be a tighter float now, which can be good or bad, right? If it's really, really tight, smaller movements or smaller trades can actually move it more. depending on the structure of that float. We're not going to get into that. That's much more complicated. And I've said this every video. I'm going to say it again. This is a very fundamental, basic, rudimentary approach to defining these issues as they pertain to the capital markets. And then, of course, they'll have a higher price per share. Those are the results of that. So let's take a look at reverse splits in kind of more of a pragmatic, but also a positive way. If you're going to do a reverse split as a company, there should be an objective defined and there should be a target you're going for. The target cannot be, I just want a higher price per share. That it's not sustainable. You have to have a reason. So should it be done? How should a reverse split be done? My attitude towards a reverse split is if you have to make that much of a change or a material change to your company structure, you should do it all at once. You should not have to do 3 or 4 reverse splits. So if you're going to do a reverse split, in this case 10-to-1, and you have 100 million shares that are not affected by a reverse split, because that's where the issue comes in, right? Why are you not decreasing your authorized if you say you don't have the intention of doing a mass issuance, which is where this matter of dilution comes in. So a reverse split does not equal dilution. A reverse split is not negative all by itself. It's what a company does afterwards that's a problem. Most of the time it's a problem, just to be clear. So I would recommend that this company, for whatever reason, they need a $50 price per share. They must have a reason to want to issue or raise capital. So there must be a block of stock for that. It cannot exceed the existing authorized. So the authorized should be decreased depending on what their objective, how they define that objective. So we can't tell them they should go to 75 million shares or 50 million shares. But whatever that percentage needs to be, it should be executed at the same time is my point. And I think that's important to understand. So what percentage should a company reduce the authorized? That's anyone's guess. I know everybody talks about 1%. I don't know how you can come up with that number. It's random. It's pulled out of thin air. It's not exactly accurate. You have no idea. Every company is different, especially with their authorized and their share structure. So I don't support that answer of 1% because that's something that's been thrown around quite a bit. And it should be done. A reverse split should, like I said, should have an objective, but it should be done with a very specific purpose on repositioning the company for a reason other than price per share. You have to be able to support that. And of course, no mass issuance after, because that is dilution. I know a lot of companies try to spin it, but it's dilution nonetheless, right? So the other thing is there's this myth out here that got to look at the convertibles. That's already baked in. That's not going to affect a reverse split in any way. Typically speaking, there are exceptions. You may have convertibles with amendments and guidelines post-reverse. That needs to be taken into consideration, obviously, but typically speaking, it's already baked in. There's this idea of a reverse split versus a normal split being a forward split. Let me just be very clear. There is no such thing as a normal split. Anytime you affect the structure of the company, you are interfering with the organic existence of that share, of that stock. So whatever you're doing, you're making a change. You're interfering with the organic nature of the stock. Is that good or bad? Well, it just depends on what you do with it. So there's just no hard, fast rule. If you go on these chat rooms and message boards, reverse splits are the end of the world. That's not accurate. It depends on what you do with it. And again, this is why I've said many times, I'm not against them and I don't hate them. I'm just very reticent to jump on the bandwagon without a purpose. So again, this is something I would consider. I'm not completely against them. I just think they're widely abused. That's just my opinion. I know it's upset a lot of people that, for the past 2 years plus, I've refused to do a reverse split. And I feel there's good reason. If you're going to do a reverse split, it shouldn't be just to maintain eligibility on an exchange or to in a way, temporarily bolster a share price, unless there's a reason to do so. So an example would be a company's bringing in funding. They've been going through a development phase. Investor confidence has kind of fallen off, but they're right at the precipice, if you will, of announcing capital funding of this technology, whatever it is finally working, and they have some contracts. Then it's okay to restructure so that the company can buy itself time and also the shareholders some time to maintain its eligibility before it makes that announcement. I think that's a valuable or valid use of that particular tool. Unfortunately, it's not always used that way. And I'm speaking specifically to OTC because we're on OTC. I'm not picking on OTC. Or OTC chief executives on OTC companies. I'm just saying that in OTC, because we're on OTC, I see it widely misused. I'm sure that is the case in other exchanges as well, but I'm speaking specifically to our exchange. So let's go over some of these myths. Myth number one, the most popular, reverse split's bad. That's not true. We've just gone over several examples as to why a reverse split is nothing more than restructuring the share structure of the company, the cap structure of the company. It's what you do afterwards. So if you reverse split a company and they do a massive issuance, you just diluted everyone. That doesn't help shareholders. If a reverse split unto itself hurt shareholders, the SEC wouldn't allow it. It's a specific tool for a specific reason or specific reasons. There's several reasons you could do it, and that's something that we should all consider. Dilution. Reverse split equals dilution. No, a reverse split equals a reverse split. It means you're restructuring the company. Dilution happens when a company or its leadership decides that they want to do a mass issuance to raise more money because it's about the money. That's a problem. That's dilution. So it's what a company does after reverse split that's a problem. And again, you can mitigate the confusion if you're a company, if you have good intentions to say, look, we're restructuring, we're lowering the authorized. So you're not going to do a massive issuance because you can't. So I think that's fair enough. As far as reverse split, can it indicate something negative? Absolutely. There's a whole litany of reasons that a reverse splits are bad, and there's many endless examples of that. So I think that is not a myth. I think that's an accurate statement. A lot of people have called in when I've spoken over the years, and even recently it was being called for the beginning of the year, and they reference certain videos. They send me links. I watch these videos. There's a lot of people on YouTube. I think they have good intentions, but they are looking at it from the point of view of someone who is earning a living trading stock. That's not what I do. My job is to build a solvent company that increases not only its operations, but its value by increasing its revenues and cash position, and then the share price will follow. That's how I view it. I think most administrators should view it that way, and that's how you get a company's share price up, other than some of these typical shortcuts. And then I know it's not always fair to label a shortcut. These tools can be necessary at times, and they can be beneficial to the shareholder. So here's the other thing: shortcut to maintain listing eligibility. Not always. I think we've covered why. There's a good example that I just went over. It's not always a shortcut. Sometimes it's necessary, and it also protects shareholder interest. Reverse split's always going to equal a drop in price. Not always, but typically yes, because you're going to see the idea behind a reverse split is often misunderstood because it's poorly communicated, to be quite frank. Companies are reticent in sharing that they're going to do a reverse split. I understand that, but it should be explained afterwards, I would think, so that shareholders understand why you did what you did. But because they don't, usually you'll see a sell-off, share price will drop. Does it mean it's fatal drop-off? No, not always. So a couple things I want to cover. These requests from shareholders to do reverse splits have become increasingly more frequent. And some of the reasons are a little bizarre in my mind. One, I understand, is you want to uplist quicker. There is no shortcut to uplisting. If I reverse split, because we want to meet the requirements of $2 or $3, those are the listing standard requirements, depending on which standard, 1 through 4, then you have 4A and B, so it's 5 standards, 3 options. If you want to do that, you have to be able to support it. So we're going to reverse split, this is what people want me to do, to $3, so we meet the minimum. And now because we have an authorized of $1 billion and issued an out of around $1 billion, just call it $1 billion to round up. And now we're a $3 billion company overnight. That's realistic? I don't think everyone thinks it through. And this is part of why we're doing these video series. You have to see it from my perspective, and you have to see it from a long-term perspective. If it's just about share price, I promise you, you're wasting your time calling me and asking me to do things so that there can be a short-term gain financially. That's not what I'm here for. So understand there is no shortcut. You have to have something material to support that value. And I know a lot of people are, before you send in messages and call in, oh, what about the multiple? You're trading at a multiple. You're not going to trade at 1,000 to 1 multiple. So that's fantasy land. And I'm being very blunt with everyone. You have to have something to support it. You have to have something in the pipeline. You have to have new revenues. You have to have new contracts. You have to have something, new technologies. You have to have an indicator, even if it's behind the scenes, that something is going to materially change in the company's operations and revenues / value that will support a higher valuation. $3 billion, I don't take those conversations seriously. One day we'll get there. It's not happening in the next couple of months. This other idea, this is twofold. Alex, we need to do a reverse split. We need to reverse these shareholders out. It can't be done. I don't know why this myth persists. You cannot reverse a shareholder to zero. Anyone who tells you that, they don't know what they're talking about. It's not accurate. Now, the SEC would not allow a company to take in money and then tell everybody to go fly a kite. That's what you're doing. It's not allowed. Can you reduce people's holdings with a severe enough reverse? Yeah, you can affect that. Reversing people out, the statement that keeps getting made to me, you cannot reverse a shareholder out. We're gonna be dead horse on that one. Now, here's the other one. Getting a lot of this. We need to do a reverse split so we can get rid of all the day traders and flippers. Day traders, flippers, people who are trading in and out of the market all day. That's a terrible attitude. I'll be honest with you. I don't support that. In order to have market liquidity, you have to have people in and out of the market every day. Those are day traders. Why anyone is viewing them as bad, I don't know. I understand they're not in keeping with whatever ethos you may have as a trader who's holding long, but we need them. So no, we don't want, without market liquidity and trading every day, we would not be able to sell. You would not be able to sell any share. We're all shareholders here. The type of shareholder should be irrelevant, whether you're in and out several times a day, several times a month, or once or twice a year, should be irrelevant. So we're not reversing anyone out because it can't be done, and we're not looking to get rid of people because we don't agree with them or their strategy. That's inappropriate, and it's not something that I'm going to support in any way. So it's a waste of time to call me on that. Now, why haven't I done a reverse split? I think I've gone over this a couple of times in the past. I'll do it again because it's pertinent to this particular video. It just hasn't been appropriate to do so. We haven't been able to warrant a reverse split to support whatever the end result would be, whatever that new market cap would be. So why would I do that just to watch the share price fall? Just common sense, I think. I also do think it's an abuse tool, but I think if you're going to do that, there's a way to do it. There are conditions under which I would consider that. It's not something we haven't discussed here. It's been brought up to me many, many times over the years. Obviously, for those of you who've been around for many years, you know I've declined to execute on that. Again, not that I hate them, not that I think they're evil, but the right tool for the right job at the right time, right? So you're going to do a reverse split. You should explain to the shareholders why you've done it, what the goal is, what the plan is, and you should back that up with action. So you should, reduce the authorized, announce whatever contracts you have, your projections on what you think you're going to do, whatever your news is, and so forth. That's the way to honestly do it. Something you rarely see. Now, is it good to buy? Now, strategy. I'm not going to give you financial advice. Is it good to buy before or after reverse split? I think it's immaterial if you're looking at the price metric. If you're looking at how it's going to trade, then that's got to be a decision up to you on what you think is going to happen. That's not a question I really can answer. I have my own strategy if I was trading, and I think many people understand how I feel about that. Same thing with forward splits. Does it hurt you in any way? I can't see how a forward split would hurt you to buy before or after. I think after makes the most sense, only because it's probably more attainable for you to do so. It's the whole reason that many companies do that. So it, again, almost immaterial. It depends on the individual and what their goals are. Okay, so that'll be it for reverse splits. The next one is going to be on some of the outstanding share issues. Float, is a higher float or a lower float better? These are all things I've got outlined. We're going to go into that. Again, no particular trading strategy. I want to cover these basic or these fundamentals, and they're all building off of the previous video. So please, it does help you to watch them in order. I would also ask to like and subscribe, as well as share these videos so we get this information out to all the shareholders. The views are running a couple hundred views per video. We have 3,000 shareholders. We're getting a lot of the same questions over and over because people are either watching videos, they're not reading social media or the social media posts or the responses to people's questions. So the more we share this stuff, the more we get our fellow shareholders educated, and that is the whole reason we're doing this, is to get everyone caught up so they're getting fair, accurate, unbiased information on some of the fundamentals. Opinions I leave to everyone else. Feel free to weigh in any opinion you might have on those blogs or chat rooms, but this should be a resource for shareholders to go to get unbiased information on how things work. So I'm going to cut it off now. I know it's been a long video. This is one of the leading topics that I get contacted on, along with a few others we've covered previously. So I will talk to you next video. We'll have another video Thursday. We just had some news out. We should have some more news this week. And then Friday, I think I'm going to do a wrap up that's going to discuss a few things as far as our news, just so things are clear. I haven't made a determination on that, definitively, but I will let you know later in the week. So hope everybody has a great week, and I look forward to talking to you next time. Thank you.